I can earn 5% in the money market account right now. Should I do anything different? Let's talk about some of the pros and cons. Hi, my name is Eric Blattner. I'm with Divvy Wealth Management, and thanks for watching. Before we get into it, I just want to remind you that if you enjoy some of the work that we do, the best way to follow along is go to divvywealth.com. That's DIVVI wealth.com. And sign up for our blog, and you'll receive our usually weekly updates in your inbox. You can also go over to YouTube and subscribe to our channel there to make sure you get notified for all of our updates and videos as we post them. So let's turn our attention to cash. Cash, for the first time in a long time, is cool again, and I guess it has been for maybe a year or so now. And this is a relatively new phenomenon, at least over the course of the last 10 years or so. Interest rates have been historically low, and now many investors are discovering that money market yields are well above 5%, in some cases 5.25%, maybe even 5.5%, depending on which fund you look at and how much money you're investing. So it has essentially begged the question: if I can get 5% on my cash, why would I do anything different? And I think it's a fair question. So investors have certainly taken notice, and money market assets are at all-time highs. You can see in this chart here how those assets have grown. You saw a spike during COVID. You saw a spike during 2007 and 8 as the global financial crisis spooked a lot of people out of the market and had folks rushing for safety. That's generally when you've seen some of these spikes, at least in the last 20 years, is when you had pain in other pockets of the market, stocks in particular, or real estate. Folks have pulled money from those markets and moved it into the secure or the perceived safety of money market funds. And so you've seen those assets spike in 2007. You saw them spike during COVID. And then again, more recently, they've reached all-time highs at nearly $5.5 trillion in assets. At the same time, you've seen bank deposits fall as, again, investors are just looking to maximize the interest that they earn on their savings. And so this other chart just shows like the historical context. I'm showing a 3-month treasury bill here that's in a lot of cases used as a cash proxy. And you can see that the current yield really is as high as it's been since the early 2000s. And yields were higher than that, the 80s and the 90s. But for the last couple decades, this has been about as good as it gets. So getting back to that question, if I can get 5% on my savings, why would I do anything different? I think maybe rather than answering that question as a firm yes or firm no, let's talk about a few of the pros and cons that come along with owning a money market fund or a cash alternative that is paying a really attractive yield. So I think starting with the pros, one of the first reasons that we would say money market funds are attractive or that they can play a positive role in your portfolio is the safety. Money market funds are designed to provide stability. They're designed to provide interest and invest in very high quality securities. So that's really the main reason I think a lot of folks go to money market funds is that perceived safety. The second piece is liquidity. A lot of investors, savers want to keep a certain percentage of their money in liquid vehicles, money that they know that they can get to without any concern in a relatively short period of time. And money market funds certainly fit that bill, as do U.S. Treasury securities. U.S. Treasuries are generally going to be among the most liquid securities in the world. So those are two of the more attractive pieces of these types of investments right now, are the safety and the liquidity. And then today's environment in particular offers a third unique pro, which is a real yield. And when we talk, like in the investment world, when we talk about returns, one of the ways that we frame that is in the context of a quote unquote real return. And a real return is very simply the return that you get to keep after inflation. So right now, inflation has fallen from last year's highs. In June or July of last year, it peaked right around 9%. And it's been steadily falling and is currently sitting at about 3.2%, somewhere in that ballpark. And the yield on those money market funds is now closer to 5.2 or 5.3. So there's basically a 2% spread between the money market yield and inflation. That 2% spread is called the real yield. And this matters because one of the primary reasons that we invest over the long run is to protect our purchasing power. Ideally, we'd like to grow it, but at the very least, we want to protect it. We want to make sure that as prices rise for the things that we consume, we are able to continue to buy the same amount 10 years from now, 15 years from now, 20 years from now. And so protecting that purchasing power is a really important part of the puzzle. And today, money market funds, cash alternatives, things of that nature are offering a real yield. So that's a bonus and a real change from the last 10 years in particular. The 2010s real yields were largely negative, as interest rates were pretty much tied close to zero, and inflation was not. Inflation was certainly not high, but it was higher than zero, and so those real yields were negative. So that's another good thing that money market funds and short-term treasury securities have going for them right now. Now let's talk about three of the potential cons that money market investors might need to think about. The first is it might increase the frequency with which you have to make decisions. And why is this a con? Or potentially, why could it be a negative? There's a lot of research that suggests, human beings, we make emotional decisions, in a lot of cases, suboptimal decisions, decisions that aren't necessarily rational. And it served us well over a really long time. And so there's good times, or there's, I guess, times when that works in our favor, and there's times when that might hurt us. And when it comes to investing, there's a lot of research that suggests human beings generally just aren't wired to make good decisions on a continuous basis over long periods of time. So my point with the money market funds, if it's a quote unquote parking spot, if folks are looking at it saying, I'll go in and buy a money market fund right now, earn 5%. Then when I feel better about the economy, when I feel better about the stock market, I'll move those assets back into something that I think is going to provide better long-term growth. And I think in theory, that sounds fantastic. In practice, the execution is really challenging. Getting the timing right of both entry and exit into those different types of strategies, I think is really, really difficult. And we may be able to get it right occasionally, but consistently getting those decisions right over time, I think is much more challenging. So rather, I think for a lot of folks, a better framework, a better concept is to really have a plan in place around the asset allocation process. How much, where are you going? When do you want to get there? And how do you want to get there? And then that's going to really help dictate how much in stocks, how much in bonds, how much in cash, other asset classes, and eliminate some of the decisions that you have to make on a regular basis. And I guess in concert, kind of reduce the opportunities that you have to make mistakes. So I think that's a potential con for being attracted to a high 5% money market rate right now. If that money's really earmarked for longer term goals, other assets may give you a better opportunity to do that. And at some point, you're going to have to make a decision of when do I go back in? And in that meantime, you might be giving up some potential gains. So just a thought, something to consider on the potential con side. The second thing is taxes. So we talk about those 5% yields. They're certainly attractive, but for high income families and individuals, the interest from these types of investments is generally going to be considered ordinary income. Ordinary income, at least in the U.S. tax regime, is going to be taxed at among the highest rates. So for a lot of those high income earners, they'll be paying upwards of 40% between federal and state income tax on that interest. So for some folks that might have tried to quote unquote park $500,000 as an example in a money market fund, paying about 5.2%, that results in interest of about $26,000. So that's going to be considered ordinary income. And again, if you're in one of those higher tax brackets, you could easily be paying 40% or north of $10,000 in additional income tax on that interest. So keep that in mind when you're looking at some of the yields from some of these vehicles. And then the last thing, I'll kind of go back to the real yields, potential con is purchasing power. Again, I'll reiterate this point that one of the primary reasons that we invest over the long term is to protect and ideally grow our purchasing power over time. We would like to, at the very least, maintain our quality of life over time. And ideally, we'd like to improve it via investing. So if we kind of zoom out, how do money market funds, how do cash alternatives typically perform when viewed through that lens? And historically, it's been a bit of a mixed bag. There's one of my favorite books is called Triumph of the Optimists, and it basically takes a 100-year look at returns for T-bills, bonds, and stocks and similar securities from a lot of different countries around the world. And I think some of the takeaways for me are that the period from 1980 to 2000, real yields were pretty attractive, actually a little bit abnormally high in the historical context for things like treasury bills and as a byproduct of that, money market funds. So investors and savers were able to actually protect their purchasing power in cash or cash alternatives during that 20-year period. Now, 2000 to 2020, it's been a little bit of a different situation. Again, we talked about 2010 through really 2020, 2021. It was a different story. Interest rates historically low, inflation was positive, and so cash actually lost real value during that period. So, getting back to that main point, we think it's important to at least consider what that money is intended to do. Like, do you need that money to grow over the long term to protect that purchasing power? Do you have other paths to do that? Do you have other assets available to do that? These are all parts of the conversation that you may want to, or pieces of the puzzle that you may want to think about when making some of these decisions. So, I guess to sum this all up, the advice that we would generally give, again, this is a generalization, but having that plan in place and thinking about where we are and where we want to be can really help bring some peace of mind in terms of how we allocate the assets, whether or not we want to take advantage of some of the higher rates in money market yields, or whether we're comfortable with the amount of the cash that we currently have spread in different types of vehicles, whether they be treasuries, whether they be money market funds, or something like that. So having that plan in place should help take some of the guesswork out of it, and hopefully eliminate some of the mistakes that can come from having to make a lot of decisions real time. Again, thanks for watching. If you'd like to follow along, go to divvywealth.com, DIVVI wealth.com, and sign up for our blog there, or you can subscribe at YouTube. Again, thanks for watching, and if we can help, please reach out. Thanks.